Hi, my name is Bruce Boldrin, and I'm founder of the Enterprise Engagement Alliance, and we're a 17-year-old organization dedicated to helping organizations enhance performance through a strategic and systematic approach to people. And part of our pledge is to share a lot of information, how-to information, insights into all the different issues related to stakeholder management. And we're really grateful to have people like the people that are joining us today to talk about a very important issue, and that's the human factor, what investors should know to uncover new value and risks. And so to our left or whatever we have, or right below, we have Bart Houlihan. He's partner of Irrational Capital, and they're an organization that has developed a human capital factor, and we're going to hear more about it in a minute, that is actually accurately predictive of future equity value equation, I should say creation. And as you know, that's called alpha, and that's something pretty important in investing. We're going to talk with Bart about that. Bart also, some of you may know, is founder of B Lab or co-founder of B Lab with two other gentlemen, and B Lab has now over 10,000 certified companies around the world. That's pretty extraordinary. Then we have Laura Queen. She's founder of 29 Bison. And 29 Bison is an M&A company that focuses on human capital analytics. So people come to her when they value people, when they consider people to be an important consideration. And she's going to tell us more about what she does and how it's relevant to you. Then we have Dave Bookbinder, who's I've known him on this journey toward the ROI of people for longer than he and I want to admit. And he is joining us to talk about the role of people in valuations, and he is Executive Director of Valuation Services for Heffley Flanagan. And then finally, we have Jason Britton. Jason has diverse interests, all related to impact investing, and he's here today as President and CIO, Chief Investment Officer for Reflection Asset Management, which is an asset management company that considers human capital. So we've really got the whole field covered here. Just quickly, what is this program about? It's part of our Stakeholder Management Forum and Library, and what it consists of is discussions like these with leading experts from different perspectives that we put on our YouTube channel, but we also summarize them so that if you don't have time to watch the show or you want to watch it later, you can at least read about it. And our purpose is to advance the practical implementation of stakeholder management and total rewards by bringing together organizational leaders and practitioners, academics and investors in all areas of this world of stakeholder management. And we cover it from two perspectives: stakeholder management and total rewards. And then finally, we are the how-to organization for this. We give away a lot of information like this stakeholder management library. So go at it. Let's make our businesses better. And let me stop this share. And I'm going to start with you, Bart, because you really have come at this. You've been at this a long time. You started B Lab, I think, in 2008, right? I think that's right around then.
2006, but close enough. Yes,
Close enough.
indeed.
And then before that, he was CEO of a startup that did exceptionally well because he sold it and exited well, and I think at a good time. And so he's going to you tell us a little bit about what you do and the state right now, in your view, of interest in this issue of the human capital alpha. So tell us what you do and how much interest is there in this concept right now?
Yeah, thank you, Bruce. And it's great to be with friends here. So you mentioned at the beginning, I'm a senior partner at an organization called Irrational Capital. It is an investment research firm that has a very simple investment hypothesis. We believe that companies that treat their people well will outperform in the equity markets. And we have discovered, Bruce, a new investment factor like value or growth or momentum. We've named it, we've called it the human capital factor. You mentioned it. And ultimately, what this is we've quantified the connection between employee sentiment and outperformance in the equity markets. Now, this is based, Bruce, on the social science of a world-renowned behavioral economist, a guy named Dan Ariely out of Duke University. And this will resonate with my fellow panelists. Dan's research was showing that when we talk about employee motivation, historically, we've measured the wrong things. We've measured pay scale and benefits and vacation time and bonuses. And importantly, those matter, but they're hygienic. It's what allows people to show up to work. It doesn't drive motivation. What drives motivation are intrinsic motivators. Things like, am I proud to be here? Do I feel recognized and appreciated? Do I connect with the values, the vision, the purpose, the mission of the organization? Is there trust and transparency? And so Dan's research was indicating we should be counting different things when we talk about employee motivation. And so we took that science and we applied it to a massive data set of employee survey data that went back 20 years, 70,000 companies, 750 million data points. And indeed, we found a profound connection between that employee sentiment, how people felt about their organization, and outperformance in the equity markets. We've partnered, Bruce, with JP Morgan, who has now written 6 research reports on the human capital factor. The most recent was last week. And they tried to replicate our analysis, and they went back 14 years. And what's remarkable is they found outperformance in the human capital factor every year for 14 years that averaged 4% per year. That's a profound outperformance. They then went on to check whether it was true across industry sector and across company size. And they found that the human capital factor outperformed in all instances. And the reason why that matters so much to this conversation is it doesn't matter whether you're coding or you're picking and packing or you're in financial services. Everybody wants to feel appreciated. Everybody wants to feel connected. Everybody wants to feel aligned with their workplace. And it leads to stronger motivation and better outperformance. And so that's what I've been doing now for the last 2.5 years. You ask where we are. I'd say largely the space is still relatively new. You know, people are learning. And I think my panelists will go deeper into this. Largely the world of human capital has been put into like the soft bucket for way too long. Like people view it as, oh, that's about well-being and doesn't really drive outperformance. And what's exciting is that all of us, I think, are seeing real data showing profound outperformance on the thing that matters most to the C-suite, which is enterprise value creation.
Well, we're going to get talk more about that with you, Bart. Swing back to you in a few minutes. Laura, you're being involved with M&A with a human capital angle, to me, was way ahead of your time. I think I've known you since, quite a while. Tell us a little bit about what you do, and then to what extent do you think companies now are beginning to get that human capital is a major factor in terms of both risks and opportunities?
Super questions. So we at 29 Bison focus specifically on the human capital aspects, mainly in the middle market of M&A, the entire M&A life cycle. So everything from the very earliest investment thesis generation. So we'll work with some of our partners in the world of financial investment to help them evaluate the state of affairs as it relates to human capital, HR, or people operations, some of the cultural components that Bart will talk about. And then we will work with them to do human capital diligence. So looking at more than 165 discrete people operations components in an organization, index them against what we know to be both best practices and compliance related capabilities in the organization, look at cultural attributes in these organizations, primarily with an eye toward the enterprise value creation, very specifically indexed to the investment thesis and to the business operation. So we're really looking at what is the current state of affairs. And if we want to get to the place where we have outperformance on a human capital standpoint, we're looking at what that exit strategy is and backing into a roadmap for value creation for those organizations over the lifetime of the portfolio hold.
So, Laura, to what extent do you think the investment community, the M&A community, is grasping on this important element that I think in 5 years ago was largely untapped? Have we made any progress?
I think we're making incremental progress in a number of ways. So, one indicator of that progress is the fact that many private equity firms have invested in creating something around a talent operating partner or a human capital operating partner. The remit for those roles is very different and it varies across funds. But I think that it is a singular indicator of the fact that we're recognizing at least the importance of top tier talent for organizations. We are then being we're able to see in the work that we're doing, particularly kind of newly fledged investors coming to us as the second generation private equity managing partners saying, I've been in this playing field for 6 or 8 years. I've run the gamut of being an associate and an analyst. Now it's my turn to invest differently. And what I'm seeing is people really matter and they make a difference. And we've kind of flubbed it up in the past. It's time for us to really double down on the things that Bart's talking about, right? Demonstration of care and recognizing that wage and benefits, for example, isn't driving performance in an organization. It's a satisficer. It's the thing that helps me to identify whether or not I am either being treated fairly and or have a meaningful purpose in this organization, but it's not driving my performance in any way. So what are the levers we can push and pull on to help us actually make a difference? So to answer your question, I think we're seeing some nascent markers in the marketplace. And listen, for those organizations that we work with on an ongoing basis, they're adherents, right? They come to us with every deal. They come to us between deals because they really get it. And that's the work we love to do.
So, Dave, you have been at this also for quite a while. I don't know when you first wrote ROI of people, what, 12 years ago, I think, 13 years ago.
Yeah, it sounds about
And
right.
and Dave, you've been in the valuation business all that time. To what extent, and I follow you on LinkedIn, so I read you almost every day, but you haven't actually answered this question in all of your posts. Not that that's your goal. To what extent is the valuation field beginning to understand the factors that you have raised in both your books?
Yeah, it's a good news, bad news situation. Bad news is we haven't made a whole lot of progress in what I would call the implementation of the kinds of things that I talk about with the new ROI thesis and the kinds of things that Bart speaks about when you think about just intuitively that there's the connection between leadership and culture and enterprise value, which has always been my lens. It started with the idea that we can do a better job in valuing people as an assembled workforce when we're doing the accounting exercise during a business combination. And there's a lot of issues. It's fraught with challenges on how to make that right. So a good place to start would be to get people on the balance sheet. But the good news is that in spite of the fact that people don't have their own line item on the balance sheet yet, what I'm seeing and hearing when I attend valuation conferences, for instance, there are breakout sessions now that are dedicated towards human capital.
Wow.
So there's conversations with private equity, there's conversations with wealth management firms, and they're talking about human capital in the context of business combination, business performance. Usually it's around, I'll call it the tried and true metrics that you would expect to get at a more of a cursory level. Things like attrition, which I think is a valuable indicator, of course, right? Because if you have hotspots, there's probably somebody who didn't get the memo about trying to do the right thing about your people. But I don't think they're fully connecting the dots yet between the impact of people and the enterprise value. So, I mean, we all here know that the high engagement will correlate with higher productivity and lower turnover and better customer outcomes. And all of those things will drive the enterprise value. Flip side is the weak culture or the instability of the leadership team will increase the risk associated with the business, right? Increased risk means increased discount rate, and that all other things equal means a lower valuation. So in valuation terms, the human capital will actually extend and expand the expected cash flows and will reduce the risk. So I think we're getting there, Bruce, but we're not there yet.
That's my impression as well. So, Jason, now to you, from the investor standpoint, investment management standpoint. First off, tell us a little bit about reflection, asset management.
Sure. So it's great to be with you all. My name is Jason Britton, and I'm the president and CIO of Reflection Asset Management. We are a Charleston, South Carolina headquartered RIA that manages individual portfolios, family offices, and endowments and foundations, specifically and only as it relates to what we call values-based investing. So things that are around thematics. So sustainability, human factors is one of our portfolios. And we have about $5.8 billion in assets under advisement. And my colleagues here, it's, as I said before, it's such a great way to be amongst giants in the industry. I wish they weren't as good as they are because they're telling too many people. It's literally alpha, and I'm making a living by exploiting it. So can we just kind of keep it to ourselves for a little while? Because
Yeah, Bart,
companies that
close the company, Bart.
companies that are really good at figuring out, right? If you're looking at the balance sheet, and back to Dave's point, we came to this not by accident, but through backward induction. We weren't as forward thinking as Dan at Duke. We weren't as forward thinking as Bob Schiller at Yale. We sort of looked at the S&P 500 broadly and said, okay, let's look at the balance sheet, look at the income statements, let's look for similarities. And you started to see things like goodwill and intangibles becoming a disproportionate amount of the assets at these businesses. And that's just accounting speak for brand. And how do you unpack that? And how do you think about what that looks like? And we sort of worked our way backwards, that the brand halo, product satisfaction, customer satisfaction, the ability to charge a premium, right, starts with people like what you sell or do. How do they do that? Well, it's because of the experience. It's either the quality of the product or the way in which they engage with it. So what does that mean? That means you're looking for workforces with experience, workforces with lower turnover, workforces with institutional memory and consistent customer experience. Well, what does that look like? That looks like a motivated workforce. So we did not get there as sophisticatedly as most of the rest of you did, but it came to us and said, wow, financial statements and modern portfolio theory, which we could do a podcast on why they keep calling it modern since it was built in the 60s, right, pre-computer, why we don't think about putting that on the balance sheet and instead, frankly, do the opposite. We don't count it, not only do we not count it as an asset, but we list it as the single largest expense on the P&L. And so as investors, we are combing through that. Like I would rather see the annual report with just photos and no words, right? As long as it's real people in the company and I can tell more about the business than I can flipping through their financial statements. So it's been a wonderful career. I've been doing it for about 25 years. Most recently was the co-head of thematic investing at Bank of America Merrill Lynch. Early release for time served. I retired in 2016. Moved to Charleston and opened up my little practice down here, and have loved every minute of it ever since.
Well, the food alone is a great reason to go there, I'll tell you that.
That's why I'm seated. We only do these from the waist up.
So Jason, and I'm not putting you on the spot, but this is a little segue to back to Bart. Have you heard of the work of Irrational Capital yet?
So I have, but I'm unique in that I really am searching for this kind of expertise. And frankly, their partnership, I don't want to put words in your mouth, Bart, but the work that you all do with JP Morgan, right? I mean, JP Morgan is widely followed. Interestingly enough, from a research perspective, they seem pretty cutting rate. There's been some disconnect with how the C-suite's talking about forcing people back to work and remote work and some of those challenges and things. But we can't all be perfect. We can't always practice what we preach. But the research is there. So I had heard of them, but again, and no disrespect, Bart, I don't run around telling people, because once you find a factor that's widely used and exploited, it no longer delivers alpha, right? It becomes what we call a crowded trade in our business.
Wow.
Yeah, that's okay, Bart. I tell
really...
everybody about you guys. I was just interviewed by a British publication this morning. I told them about you. So I'm out there championing the cause. Sorry about that.
Well, that actually is a very
it is the
good
right
point.
thing to do.
Jason, that is a really good point, though. Think of it from an investor standpoint. And by the way, have you ever noticed stakeholder capitalists never brag about it? The real ones never talk about it. John Mackey never talked about it when he was building his company. The folks that started Costco, they didn't, because it's a competitive edge. Why brag about a competitive edge? So, Bart, let's get back to you. One of the things that you didn't get a chance to talk about is the fact that you actually are providing, I think you're selling into the marketplace a tool that companies can use to assess their progress toward the human capital factor. Can you tell us a little bit about that tool?
Sure, Bruce. There's kind of two halves of the work that we do at Irrational Capital, one of which is we actually create indexes that we use to make this proof point really clear to investors. And so we have a variety of indexes that are out in the marketplace that underpin some ETFs that are offered by a group called Harbor Capital. And the reason why that's so important, Bruce, is it makes it investable, and it also makes the alpha clear to everybody. You can actually deploy capital into the human capital factor into companies who are following this approach to running their business, that they value human capital, they recognize it as a competitive advantage. When I learned, Bruce, coming out of, I did the B Corp stuff for damn near 20 years. It was a long, wonderful run. And at the end of which, I was trying to figure out what would be next. And when I found Irrational Capital, and they were talking about that they had found this connection and they had evidence of it from JP Morgan, what I got excited about was the fact that it did work in every industry sector. And the reason why that was interesting is it created the opportunity to build a tool to bring the human capital factor to individual companies so that they can figure out how their own culture is aligned with future value creation. And so we have a tool that we've been using now for about a year and a half that allows an individual person or individual company rather to do a demographic analysis of their firm and find the hotspots in the organization where emotional connection in my Des Moines plant is not right now aligned with driving my value creation strategies. It works for private sector companies, it works for public companies, and it works across industries. And so for me, the reason why that's a lovely segue from B Lab, if you think about the B Corporation work, that was all about leading with impact first and demonstrating really clearly that it was a better way to do business. Irrational Capital is the exact opposite. We're leading with very clear alpha, proven by JP Morgan. And oh, by the way, Bruce, if we all actually can drive this appropriately, it should lead to profound corporate behavior change, where indeed employees are treated better. And so that to me is how this all cycles from my time at B Lab and building the B Corporation movement to now the Irrational Capital work. And so it's been fun to come around the other side and start with outperformance and start with clear evidence and then do that in individual companies. And that's called the human capital factor rating system.
So essentially, companies can come to Irrational Capital, and it's not a Gallup survey. Obviously, it's not a Q12. But it's an analysis process that's systematic and comparable.
That's right.
Which I think is really important. So this would be, and this isn't a sales pitch. I don't work for Irrational Capital, although I believe in their work. But it sounds to me like this is a tool that any company can use to benchmark itself and
That's
to
correct.
identify risks and opportunities, and then to identify leverage points. Well, I want to get to this thing quickly. I'm going to put in the back of your heads, folks. The last question are the questions that you think are most important in evaluating companies' people, risks, and opportunities. So put that in the back of your mind. But one of the things that I found really interesting about this election in New York City, why am I bringing that up? I think what we learned is that 50% of the people in the nation's capital of capitalism don't like capitalism. Think about that. 50% of New Yorkers voted for a democratic socialist. So I think what we're really, to me, everybody, I think the problem of capitalism not being liked is actually a value destructor. It is because when people don't like companies, they have zero loyalty. So, Laura, when you guys are going into without a tool like what Bart has yet, and you're doing an analysis, where do you get the data? What I'm finding is that companies have very poor human capital data and that it's all over the place and hard to correlate. What have you found?
Well, we spend most of our time in the middle market and the lower middle market. And so the dearth of actual analyzable data is something we deal with every day. So a lot of the time we actually go in and help to create it. I mean, sometimes that means manually constructing census files and then using some retrospective analysis. And in some cases, that's qualitative data. So we'll go in and spend time talking to the employees about the employment experience in the organization, and then using that and trying to correlate it against turnover calculations, for example, the length of time between hire and termination for low tenured individuals, and then parsing some of that information back to the qualitative data. And this is to a point that Dave was making earlier. You can begin to see patterns. Are we losing people short term in one sector or one department or under one leadership in the organization? Now we need to go in and understand more deeply, what is the employee experience? What's happening in that space? It could be a very quantitative circumstance, like individuals aren't being paid to a reasonable fairness factor, either internally or externally to the marketplace. Do we need to do something to adjust that? Or is there something that is quantitatively different about their experience in the work environment related to their situation? Is it a caring issue? Is it an understanding issue? Is it a communication issue? And we'll begin to parse that information. But we'll look at all aspects of that employee experience. Everything from what do benefits look like for those individuals to what are the safety factors for that organization? Are we seeing a high safety risk? Are we seeing high illness, high absenteeism in particular aspects of the organization? One of the things we're looking at much more closely now than we did in the pre-COVID or pre-pandemic period is how much learning is happening inside the organization, because we have heard, particularly with the younger members of our workforce, those cohorts are looking for opportunities to advance, even if it's not in a linear hierarchical way. They want to better themselves. They want meaning and purpose, and they want the ability to master capability. And looking at the way an organization operates in building some of that talent and not replacing them from outside, but creating career pathways for them is critically important to long-term employee retention and to all of the things that contribute to this alpha, right? It includes productivity and performance. And now we think about things like AI, for example. How capable are the organizations creating their workforces to be able to utilize those technologies?
So, Dave, a question I have that's coming right out of all of this is the issue of data. Think about it. My son works for an engineering company, a major, they have tons of data, lots of data about everything they do. Everything's managed by data. And here, what I'm hearing, and I think I already know, that about 50% to 80% of a company's balance sheet is goodwill with almost no data. And if there's data, it isn't standardized. It's not like you can, compare the calibration of one company very easily to another. But Bart, we're getting back to you on that. So Dave, how do you manage the fact, or tell me if I'm wrong, that companies often don't have the type of data that people like Jason would theoretically want, and that you would want?
Yeah. So in my world, Bruce, when we're talking about valuing intangibles, we do have to rely on data, right? We can't just make stuff up, so to speak. Everything we have to do has to be documented and sourced, and it's got to pass muster with a variety of constituent review organizations, whether it's an accounting firm or SEC or the IRS or what have you. So we've got protocols and procedures that we have to follow, and data is critical. When you talk about that chart that we've been alluded to here, the Ocean Tomo bar chart that everybody talks about, and I have as well in my writings, that shows the flip of the script, that companies today are predominantly their value is based upon intangible assets. It's more than just goodwill. So I don't want to get too wonky with you, but goodwill is the intangible value that's left over after you value all the other stuff that you can identify. So yes, it includes things like brand and trademarks, but it can also include things like technology. It can include things like customer relationship assets and things like that as well. So I just want to be clear on that. But the data component is absolutely critical. And when you start to think about bringing human capital metrics into the valuation space, which is certainly what I continue to talk about a lot, Part of our being hamstrung is that there isn't great data that allows us to do what we need to do that's going to pass muster with those constituent review organizations.
And by the way, that's critical because I've spoken with Dave about this in the past, and things that to us might seem very obvious as something that you might be able to say, this is the value of that asset. According to Dave, it's not so simple as that because you're dealing with a legal functions taxation, and you can't just invent valuations. You have to back them up. So, Jason, now, you're in an interesting situation in terms of evaluating investor interest in this because obviously no one would be coming to you if they weren't interested in these intangibles that you are, helping, turn into tangibles. What do you do? And again, I know you don't want to give away your secrets, per se, but help us a little bit in this world where companies can't even measure whether their incentive or recognition program had a true impact, and they often don't even bother to measure it. They'll spend millions of dollars, and then you'll say, "Oh, gee, what was the impact of that?" And they'll shrug. So, Jason, how do you deal with this total lack of coordinated data?
So you're exactly right, Bruce. It is incredibly challenging because there is no standard format, right? There is no generally accepted accounting principle for how to measure all of these different things. And then even some of the tools that we do have, and even in the space in which I spend most of my time, which is towards the larger capitalization US publicly traded companies. And virtually all of them have some sort of employee survey of some kind or another. Um, what I really find helpful is if they'll give you sort of anonymized results from that, and then but they tell you one thing, which is, was it compulsory? Like, did you have to do it in order to get something like a paycheck or whatever, or check this box for your review, or was it voluntary? That usually will tell you a lot of information. But everyone's spot on. It's few and far between. It's inconsistent at best, and you start to look for approximations, right? So you look at things like, for me, like workforce composition a lot of times, right? It's not perfectly correlated, but it'll get you part of the way there. And I refer to it as building a mosaic, right? So when you've got one little piece here and you start to put them together, like it's not until you really pull back at, call it 10,000 feet that you can kind of sort of start to see the picture forming. But, we look at things like the highest paid employee, which typically is the CEO, but not always, relative to average worker wage. We look at turnover. We look at things like absenteeism. We look at job tenure. You look at safety issues. So a lot of that information, at least prior to about 35 days ago, was something you could get from government statistical agencies and the National Bureau and places like that. Beginning to wonder how we're going to rebalance at the end of the fourth quarter, since a lot of that data may never ever come back. But not to be cheeky, but mentor programs, dollars spent on training and development. One of the things that I think that we do particularly well is not lean into any one particular data point, but lean into multiple data points and use them within sector peer groups to pick and identify winners. So while every data point isn't necessarily relevant in every specific sector, as long as you're using it with all the companies in IT or all the companies in financial services or all the companies in healthcare, you start to sort of see the leaders. And again, not to give your listeners too many secrets of how the sausage gets made, but if you can pick a handful of winners in each of the sectors and then broadly invest in them, that's better than about 99% of the asset managers that are out there time and time again. So while I do like to think that, we're the cat's meow, like you can be the valedictorian of summer school and still pull away pretty substantially from most of that peer group, because they're either doing one of two things. They either don't care at all and are market cap weighting, and they're just tracking an index and trying to make a fee, or they're actively managed and they're looking at the wrong information and their alpha is huge when they accidentally get it right. And then there's enough alpha that's there that when they get it wrong, it sort of narrows it. It's almost like mean reversion on the active management side. So the reality is if you put in the work and you're looking for the right things, even though we don't have great data, it's still, broken clock, I guess, as they say.
Well, it is so ironic that we have no data on our organization's most important asset or no standardized data. So there's really no way to actively compare. Bart, you do have a way to do that. You do, right?
Mhm.
And you know what I find interesting in your results, the 4%? Our organization created the Engaged Company Stock Index in 2012. It ran from 2012 to 2018. It was a longitudinal study. It was not a regressive study. In other words, Lori Bassey, McBassey, a leading analytics firm, had something called the Good Company Index,
Yep.
and she created a portfolio for us. It was managed by her and her partner, and it was up, listen to this, the coincidence, Bart, 37.8% compounded over 6 years.
Yeah.
That's pretty much what you guys are doing. Then a guy named Alex Edmonds, some of you may have heard of him. He's a
Mhm.
professor of finance at a London Business School. And he did a regressive study for 27 years. And this was actually back in 2015 of great places to work. And that too had an average alpha of about 3 to 4%. So we're looking at now, obviously, Jason, if everybody's trading on that, then obviously the quick wins aren't that easy. But Bart, in that respect, what do you think are the most important factors? And let me stop for 1 second. The one problem I have with all of this, a
Hmm.
big problem, is that nobody's really looking at customers. And frankly, I think customers are just as important, if not more important. And we did research at Northwestern University over 10 years that found a direct link, and this is getting back to you, Bart, so I'm swinging back to you, that found a direct link between high levels of employee engagement, right? Customer satisfaction and finances. And how did we do that? We got the financial results of 26 hotels in a major chain, and we got their employee engagement data, we got their customer engagement data, and we got their finances. And in 24 out of the 26 properties that outperformed, there was a clear correlation between high levels of engagement at both. But so what have you found, Bart? And what are the factors that you really looked for? And Laura, you spouted out a few. Jason, you mentioned a few, but I'd like to kind of narrow that down. That in an ideal world, well, first off, Bart, tell us what you've learned. What are the
Yeah.
factors that seem to be most predictive of future value equity creation?
Yeah. And so obviously we have a point of view based on this human capital factor, and there are other really material important metrics out there that have already been mentioned. To talk about what the human capital factor is, what we're trying to measure, Bruce, using an employee engagement survey, what we're trying to capture are these intrinsic motivators that I talked about at the beginning. And the ones that we see time and time again lifted to the top of the list as most impactful: appreciation, recognition, connection with purpose and vision. We look at 30 different questions that then organize themselves, Bruce, into 7 dimensions that we call the 7 dimensions of the human capital factor. And they're not going to surprise anybody on the phone, right? It is, or on this call, it includes emotional connection, direct management, innovation, organizational alignment, organizational effectiveness, extrinsic rewards. And ultimately, what's been super interesting about that analysis, going back a full 20 years, Bruce, the one that year in, year out is the least correlated with outperformance is extrinsic rewards. Every year. Many times it's not even statistically significant,
Wow.
statistically
Significant.
connected to outperformance at all. And so we're stuck with, if you talk to normal mid-market, whom Laura works with every day, CEOs and C-suite professionals, and they know that they have a challenge with the culture in the organization, time and time again for decades, they immediately go to extrinsic rewards. What can we do with comp? How do we figure out a better benefit package? And ultimately, that is not driving motivation and outperformance. And so this view, and let me make it really tangible, Bruce, because I think this will resonate, and it comes back a little bit to what Jason was talking about. I just want to talk about how we construct our index, our large cap index, because I think it'll land the plane on this conversation. So we have human capital factor rating scores on all 500 companies in the S&P 500.
Wow.
Okay. We take the top 150 of those 500, and all we're using to develop that score exclusively is employee sentiment data. We then market cap weight that top 150 and industry sector weight that top 150 so that it has a direct correlation with the S&P 500, literally a beta of 1 with the S&P 500 and 99% correlation. In year out, it is leading to 4% outperformance. We use no financial metrics whatsoever. We haven't looked at PE or earnings per share, or ultimately, all we're doing is giving exposure to it for an investor to these highly motivated employees in the top 150 companies across all sectors. And the fact that it consistently outperforms comes back to the reason why you call us together, Bruce. Like, ultimately, it is really clear evidence that there's a direct connection between how you treat your people and alpha. And it's so clear in this very simple example of exclusively using employee sentiment data to choose the top 150 out of the S&P 500. And year out, it outperforms.
Now, did you folks see that article about the incentive program used by the Ukrainian army? It's extraordinary. Highly recommend. In fact, we have an article in it in our media today. So I will make sure you all get it. Essentially, they use a points program. This is very interesting. I'm watching the clock here, but it's relevant to this. They have a points program for the soldiers, and they earn points based on how many people they kill, how many people they injure, how many people are captured, and how many tanks and and they get points for each of them. Then what happens? They redeem their points for an Amazon-like store, an incentive program. But what are the prizes? Better drones, better rockets, because they have a scarcity problem. So it's an intriguing way to ensure that all of the employees are reporting the data. Think about that. The incentive program becomes a means of getting data so that they can then allocate the resources to the right teams that are using those resources the best. And then when they interviewed the people, everybody said to Bart, and there's a big question for you at the very end from what you said. All of them said, no, we're not motivated by the points. That's not what we're motivated. We want to kill the Russians. We want to win. But the points are fun. They'll talk about them and when they're sitting in their whatever tents or wherever they're lodged. But it also has negative consequences too, because then they have a moral guilt. Wait a minute, I'm all excited. I just killed 10 people and I got 1,000 points. So it really is interesting, the psychology of this. But Laura, isn't the holy grail to find that metric that really is going to identify future alpha performance? And what we're hearing from Bart is that the data shows that you can determine this without any financial information. Is that the holy grail here of having, and I'm going to ask Jason and Dave too, if you had, and I'm not trying to sell for Bart, I promise, but I myself have been searching for this. Because we have this in engineering, you have standards, right? You have standards throughout industry, standards in railroads, but we have no standards in people management. Is this, Laura, is the type of work they're doing, could that really help the work that the three of you are doing?
1,000%. And in fact, I have shared with both Dave and Bart individually, this conversation is the unicorn conversation for an organization like us. It's the thing that bridges what we have known inherently. And I've spent most of my career in the world of HR and administration, being able to create the bridge between what we know to be the right way to operate businesses because it creates a good outcome, and being able to have a cogent conversation with business leaders about something that is not investable and doesn't show up on a balance sheet. It is quite honestly problematic. I think there isn't a universal right indicator. I think there are the right indicators for organizations to double down on, as in the human capital factor, for example. what makes the material difference in each organization is the application of that information appropriate to that organization's circumstance. It's not enough to say we have the data and the information. It is how then do we take this data and do the right thing for all of the stakeholders in the universe around that organization, which includes, to the point you were making earlier, Bruce, things like customer outcomes, patient outcomes, return visits to an ER, for example. It is all of those kinds of things. And what is it that is the corollary inside the 7 elements that Bart's team is looking at that can be pulled on to increase employee satisfaction that translates all the way to the business outcomes that are most important for that organization and for its investors?
Dave, do you think it's possible to come up with this, a kind of a standardized framework, understanding, as both, Bart and Laura have said, big companies are different, right? Boeing is very different than a shoe store, a store, a chain of shoe stores. But do you think, like Dave, if you had to come up with 3 metrics that to you are either red flags or green flags, are there any in particular that are important to you?
I want to answer your other question that
Oh.
you started to ask about, is it
Thank
possible
you.
to do this? And I think the answer is yes. And I'm going to tell you why. So when I first started on my journey about the new ROI, return on individuals, it was my literal journey to explore and prove that people really were a company's most valuable asset. It spawned from the idea that we didn't value human capital correctly, in my perspective, and from a valuation lens, right? And along that journey, and this was well before irrational capital and the human capital factor. So what I came to learn was I looked at those studies that you alluded to, the McBassey studies, the Great Places to Work studies, and learned that, in fact, the ones that are doing the good stuff, the great places to work, they're doing right by people, outperformed, and they had a lower cost of capital. And in my world, in valuation, the value of the business, it's a present value calc, right? The lower the cost of capital, all other things equal, the higher the valuation. So I actually posited and envisioned this one day in the future in the valuation space, we would make an adjustment to our cost of capital calculation, the same way we have a company-specific risk premium in the cost of capital calc. And I actually called it in the book the human capital investment factor. And again, this was way before the human capital factor. So I love those guys. And I'm not taking credit for what they did. Don't misconstrue. It's just an ironic circumstance. But I envisioned a tweak in the discount rate to capture what we intuitively believe would be that the companies that are doing better and have more engaged workforces ought to be valued higher than the ones that didn't, right? And that adjustment would happen in the discount rate. And when you talk about those larger companies and the complexity of data, everything that I do in my day-to-day is taking that big data, looking at those large publicly traded companies, and bringing their metrics into the privately held business world in valuing these privately held companies. So long in a way of getting to, yes, I do think, Santa Claus, there is a way for us to do this, Bruce. And I would love to find a way to partner with Bart. He and I have talked about it. My hurdles are that there's a huge constituent audience that I referred to before that's got to bless these types of things. But I do think there's a way for us to translate that public company data, bring it into the privately held business valuation world, and actually change the way fundamentally that we think about valuing people inside an enterprise value calculation.
And Dave, you're just young enough to pull that off because it's going to take some time. Jason, from your standpoint in the investment community, is this kind of the holy grail of trying to come up with metrics that really are, look, there's nothing perfect. And by the way, even perfectly run companies can fail. Let's be honest. There are factors, I hate the sense that, oh, if you all follow this, you're always going to succeed. No, you have a competitive advantage perhaps. But Jason, from your standpoint, do you think it's possible to get to where Dave and Bart are talking about, where there could be, some pretty targeted metrics that you can really focus on?
So I do. I think that not dissimilar to a lot of the things that we've seen the sustainability space go through over the last 40 years around carbon accounting and measuring greenhouse gas emissions and the actual cost of what it means to be a polluter and to think about resources, inputs, throughputs, and outputs, to apply that level of thoughtfulness and rigor to human capital, I think is absolutely possible. And as I was joking before, as I'm wont to do, I do hope that it becomes standardized, and I hope that every company does it, right? The same way I hope that we figure out a way to make sustainability practices ubiquitous, and we actually figure out a way to fix climate change. So if every company in the S&P 500 becomes a good employer of human capital and a good steward of the labor inputs of the people who work there and their stakeholders and communities and supply chains, then you know what, that'll be fine. I'll be willing to leave some of that alpha on the table if that's the outcome. Just to be clear in my position. But I will say this, for every forward thinking, and I don't use the term progressive necessarily in the political context, but progressive, thoughtful, engaged, open-minded management team, there will always be idiots out there who are exploitive. There will always be people out there who are doing the wrong thing for the wrong reasons. And I think that the kind of work that this panel is doing will continue to both identify that, but also demonstrate the clear distinction between those that are doing the right thing and those that aren't. And we'll be able to seriously not only make investment decisions based on it, but personal consumption decisions based on it. And writ large, I think, back to Dave's point, I'm going to try to weave those two things together. Eventually, people will stop doing business with you, which means banks won't lend to you, which means your cost of capital goes through the roof, and then hopefully you're out of business. So if you don't become a steward of all of your resources, human capital being amongst them, then I think it's at your own peril.
Well, Bart, I'm going to give you the last word on this. It seems to me, I've been at this quest since 1989, and I probably look it. And we've made a little bit of progress. We have. And what we learned 18 years ago, Bart, the argument is not going to be one on a moral issue. It's getting back to what Jason said. It's not going to be one on an ethical issue. It's going to be one on a practical financial issue that companies that are short-term focused, you can make a lot of money with a short-term focus, like Ponzi schemes, for instance, right? We have the remains of a BP plant in our gorgeous town of Hastings-on-Hudson, 27 prime acres right on the Hudson River. It's a Superfund site that will take another 10 years to clean up. I think it's costing BP shareholders $25 billion, 35. Now, who are the shareholders that caused that? They're dead, right? So what that company did is it just kicked the risks down the road. So to me, Bart, aren't we going to win this argument really on the fact that it's better business?
100%, Bruce. And I think you have unanimity from this particular panel on that front, that if you're trying to win this argument through virtue signaling and morality, you're not going to get there. And if I step back and talk about the B Lab work and 20 years of time there, ultimately it was just a different approach to try to prove the same point. That in fact, as Jason was just talking about, you measure and manage the impact you have on all of your different constituents, employees, customers, community, environment, your governance practices. If you manage all of that, it's not only the right thing to do, it leads to a much better business. And you've heard me on this, Bruce, going back to COVID, if I look at the B Corporation community of, thousands of companies globally, we were looking at failure rates of between 1 in 3 and 1 in 6 of small and medium-sized businesses across the globe, right? It was a massive economic impact. Our community of certified B corporations had an attrition rate of less than 5%. And they outperformed not in spite of managing and measuring their commitment to their workers and to the broader community, but because of it, it just made them a more resilient business. I think what you'll find across the board from your panelists is wholehearted agreement that specifically applies with regards to your employee set and your workers. It couldn't be clearer. The challenge has been historically, how do you prove it and how do you measure it? But I think there's unanimity. Again, if we asked managers across the globe what their single most important asset is, every time they're going to say their employees, every time. What our job is to be able to measure and manage it to a degree where we make it self-evident to everyone else that this is indeed a better way to do business. That's the
So,
end game.
scale of 1 to 10, one question for all of you. How, if 10 being a fully mature world where we're really focusing strategically on human capital in our evaluation processes versus 1, no interest. Bart, where are we in this country on 1 to 10?
Repeat the question again. I got the
How
1 to
far
10.
along are we?
Yes,
I'm sorry, I'm not great at this like Dave.
that's all right.
How far along are we as becoming mature in the
Oh,
application of human capital principles in investment management? 1 to
oh,
10.
4, somewhere around there, 3, 4. It's still relatively early days. The S in the ESG has always been elusive, difficult to measure. Workers is one element of the S. It's just hard to capture. There's some beautiful work being done by BCG around a private equity pool of common metrics they're using, but ultimately I'd say, Bruce, this is going to go the opposite way, that we're going to have to prove efficacy and get buy-in to then drive broad measurement. I don't think it's going to start, and that's what this entire panel is trying to do. Save Jason, who's trying to hide the alpha, which I understand, Jason.
I know that's part of the problem here. You're
I
a bad
get you
guy,
there.
Jason.
I get it. I totally get it.
So just a quick answer then for Laura. He says 4. What do you say?
I just said 2.5.
Dave?
Since we're just coming off the World Series, I processed your question in baseball terminology, and I was going to say 3rd inning.
Yep. Jason?
I think that's right. I think it's early days, and I think it's going to ebb and flow. I think if you'd asked me 18 months ago, my number might have been a little higher than it is now. But we'll see. Ask me again in 3.5 years.
Well, we're going to be here to do that. So I want to thank all 4 of you. Thank you. Bart Houlihan of Irrational Capital, and you'll be hearing more we've written about him, and we're going to stay in touch with what he's doing. Same with Laura Queen of, I was going to make a joke, of 29 Bison, who also we are going to continue to follow your work. Dave Bookbinder, you know that we always do, and Jason as well with you. So folks, this show is going to be posted next week on YouTube. And there'll be a summary article in our ESM, and it's going to be in our stakeholder management library for the rest of time. So this is a wonderful reference and I thank all of you, and I'm going to ask you to hold on for 1 minute of housekeeping. Thanks again, folks.